There is caution, there is worry, there is more macro headwinds to come, it feels like.
Yeah, there is, but none of this is really new. I think a lot of this is left over from December. And we had a really rough month in December, especially at a time when it was supposed to be this year-end rally possibility. None of that actually came to fruition. So investors heard again from the Fed today about their determination to keep rates higher. Again, not new news. So anybody that was caught flat-footed on those minutes, I think maybe hasn't really been paying attention. So yes, they're going to keep rates higher, but here's the good news. We may know by the end of the first quarter whether or not they're done hiking. Right now, the only thing that's baked in is 25 basis points in February and another 25 in March, and then that might be the end of raising rates. And then we just have to figure out how long they pause for.
To that end, have we seen enough of that starting to be baked into the overall valuations, particularly in the world of technology? We have seen some of the big tech names, Apple, for example, really rolling over. Have we baked in enough of the bad news when it comes to interest rate hikes?
I think we've baked in the idea of monetary tightening. So that happened largely in 2022. Obviously, the huge drawdowns that we saw, particularly in growthy areas of the market. So we've baked in basically the Fed's hawkishness. What is not yet baked in is whether or not we're going to confirm a recession. So if we do confirm a recession, and I think we would know that by labor markets actually starting to crack, then stocks likely need to go down further. Usually recessionary drawdowns are beyond 30%, and the furthest we've gotten so far is 25%. The other thing that I don't think is quite baked in yet is when earnings revisions come down even further. Right now, they're still showing estimates for 2023 as year-over-year growth being pretty flat compared to 2022. I can't imagine that that's going to end up being the case in an environment where revenues are likely to come down, wage pressures are likely to stay sticky, and companies are going to see their bottom line and their margins get pressured. So I would expect earnings revisions to come in and show more of a contraction somewhere in the range of 5 to 10% for the year. I don't think that's all priced in yet either.
Well said, and in fact, sort of agreeing with you is Mike Wilson, of course, a bit of a perma bear, the right bear it was last year in terms of some of his calls. He's over at Morgan Stanley. He had this to say when we heard the news out of Salesforce, the job cuts, and indeed whether or not big tech is a good cost cutter. Just take a listen, Liz.
The thing that concerns me about tech companies, John, is that they're not good cost cutters traditionally, right? They're growth companies. They tend to want to invest into these downturns. They want to invest, aggressively through all periods of time, and they're just not good at cost cutting. And so they're going to be late on that. They're probably not going to do enough. And so it'll take longer than you think. And so the margin degradation could be more severe in those areas.
Liz, you bracing for more cost cutting and indeed perhaps not that effective a cost cutting coming from big tech?
Well, look, I have a lot of respect for Mike. I've been called a perma bear this year and for the last 12 months because I continue to be cautious. So I align with a lot of the things that he's saying. Now, tech companies cutting costs, he's probably right that they're not used to doing that. He is right that growth companies do tend to reinvest in the business. That's the idea of a growth company. That's why you also don't find a lot of growth companies that pay out dividends or engage in stock buybacks, because they're taking that capital that's available and reinvesting it into the growth of the business. Where I think any business is going to suffer in 2023 is in what he said, if they wait too long to cut costs. Because if and when the labor market starts to show signs of weakness, the consumer likely pulls back. That can happen very quickly. And if companies are only modeling out one quarter, one half of the year at a time, they might not cut costs quickly enough in order to pivot and catch sort of that revenue degradation that could happen as a result of lower consumer spending.
What are some of the upside risks, Liz?
The upside risks are that if we do have a recession, what we need to continue paying attention to is that it would reset the business cycle. I said that in my 2023 outlook. I'm going to keep saying that probably for the entire first half of the year. We do need to reset the business cycle. We are decidedly late cycle right now. In order to get back to early cycle, a recession would reset it. And then we can start talking about where are the opportunities? What are the opportunities that we would see in a classic coming out of a recession scenario? And in that case, I would be looking at cyclicals. I'd be looking at small cap value. If the market gets down below 3,500, I'd start looking at cyclical parts of tech like semiconductors. So we can start to think about that. The other thing that's positive is that bonds are, again, a decent option, and they are trading at really good valuations, but the time is now before a recession is confirmed.
Are you talking treasuries here, or what about corporate debt? Because actually some at Bloomberg Intelligence are anticipating a whole raft, perhaps, of corporate debt to be issued by some of the big tech companies.
Yeah, good idea to distinguish that. I am talking about treasuries. The time is now in treasuries, particularly 2-year treasuries before a recession is confirmed. Corporate debt, however, the way that we look at that is typically the spreads, and you can look at the spreads over the 10-year treasury, for example. Corporate debt has not shown recessionary valuations at this point. So I would say corporate debt is kind of in that equity market camp where it's shown some valuation compression, but not enough to say that, okay, we're ready for the recession to be here, or that we've actually priced in a recession. So I would expect corporate debt and credit spreads, particularly in the high yield space, to blow out wider before they start to come back in again.
And Liz, just for our viewer, whether they be a retail investor, whether they be more of an institutional investor, are you thinking in the next, as we've got so much uncertainty still, upside risks and indeed downside, more cautious trading upon us, is it best to be broad, or is it better to be doing your fundamental analysis on individual companies? Is it more the earnings that you start to look at, or is it more the macro and the data that you're going to be focused on?
Well, 2020 year was absolutely a year of the macro. It was a very macro-driven environment. 2023 is likely to have some macro forces still hanging over our heads, obviously in the middle of a rate hiking cycle. But the good news about that is that I think the rate hiking cycle is beginning to mature. So some of those macro forces won't be as interesting to the market anymore, like we've already discussed. I think a lot of that monetary tightening has really been baked in. So it is important to look at the fundamentals. It's definitely important to look at the quality of a company and their ability to generate revenue, their ability to cut costs and manage not only what they're reinvesting in the business, but what they're able to return to shareholders. And that's why dividend strategies have been so popular, because it has been this returning some of that value to shareholders. Fundamentals are absolutely important. Valuations are probably the most important part of that fundamental story in 2023.